In this video, I'm going to give you 5 top trading strategies that you can apply and can definitely change how you trade the markets. So these strategies can be applied on indices or even Forex or any other tradable instrument depending on your choice. So without further ado, let's actually jump into the content. The first strategy that we are going to talk about is called the continuation M and W entry pattern, right? So we are basically trading in line with the trend, and the trend can be determined by several techniques, which can include market structure or even indicators. So like in this particular case, we can say this short-term point or this short-term phase was actually an upward trend. Why? Because we had an upward move, then creating a high, creating a low, then creating a higher high, creating a higher low. Therefore, we can say this particular phase phase that we have was actually an upward trend. Or we can employ indicators, particularly exponential moving averages. These are the 50 EMA and the 200 EMA in white, like that. So basically, when these cross to the upside, we would say it's an upward trend, and when they cross to the downside, it's a downward trend, like that. So we are saying the first thing is to determine the bias. Is the market going to the upside or is the market going to the downside? When we are going to the downside, we would be looking to get M's, and when we are going to the upside, we'll be looking to get W's. So let's have examples on this particular strategy. In this case, we can see that there was a crossover of these EMAs to the downside, meaning we are in a downward trend. After determining this bias, the next thing was now to look for M's at the 200 EMA region, which is the white one. So going further, we want to see nameable patterns or clearly nameable M's or W's. We can see at this particular point they attempted to create a nameable pattern, but the nameable pattern should be confirmed with the trader's dynamic index, whereby we can see the first leg being outside the bands and then the second leg being within the bands, like that. Therefore, in this particular case, we had a nameable M pattern where we were going to make an entry at a candlestick reversal pattern at the second leg of that particular pattern, which is at this particular point. Therefore, that is how it goes. So basically, that's the first strategy, whereby you are only going to be looking for crossovers or basically determination of the bias using any other trading criteria. The second strategy is actually called the third day reversals. This includes or this looks at trading against the head when what we are looking for has been fulfilled. The first thing that we need to see is actually a 3-day move in one particular direction. What do we mean by a 3-day move? These black traces are actually marking a period equivalent to a day, and whenever we have 3 of them in one particular direction, we expect to see a reversal. That reversal will include an M or a W or a head and shoulder or an inverted head and shoulder, depending on what they have actually issued. How do we know if the market is going to give us an inverted head and shoulder or a head and shoulder? Usually the second leg will pierce above the first leg. So here are the examples of this particular strategy. We can see that we had a day that was in a unilateral direction. Then we had another day, and then we had the last day, which is day 3. When we reach day 3, we start to look for a multi-day M pattern or a multi-day W pattern, depending on market context. In this particular case, we had an upward move of day 1, day 2, day 3. At day 3, we wanted to see the first leg being created, and then the second leg will be created in the following day. Therefore, we had the first leg, the second leg being created to create a reversal. So the reversal was issued, and we start again the same count. the same count, day 1, which was this one, day 2, this one, and day 3. At day 3, we expect creation of the first leg, and then at day 2, we expect creation of the second leg. Our entries should be made on the M15 time frame, where we will see a proper or a nameable candlestick reversal pattern. On the M15 time frame, this is where we're going to make our entry. As an example, we had a bullish engulfing pattern that was issued at this particular point, so that is where we would have made our entry. So basically we are saying look for 3 days in one direction, and then at the end of the third day look for the first leg, then the second leg on the following day, basically like that. Our third strategy is actually a strategy that incorporates the trader's dynamic index, whereby we look for what we call the shark fin on the TDI on H4 time frame. So the first thing is basically to go on the H4 time frame to look where, or to look on points where the market actually pierced outside the bands on the TDI. So basically this is the TDI, and on the TDI we can see phases where the market actually went outside the bands, and on those points that is where we are interested in trading from. So basically when the market goes outside the bands and when it goes inside the bands, we can call or nickname that scenario as shark fin. And when we see a shark fin on the H4 time frame, we will need to go to the H1 time frame to find a nameable pattern, which basically is an M or a W pattern depending on the market context. So I have already marked the points where the market gave us shark fins on the H4, so we can go directly on the H1 to see how the market played out. So in this particular case, we can see that on the H1 time frame, these lines, these fainted lines, are the points where the market made the shark fin on the H4 time frame. And we are now looking to get M's and W's. We can see this was the first leg, and on the following day they created the second leg and a bullish engulfing pattern. You can minimize or lower your stop loss by looking for a proper candlestick reversal pattern on the M15 time frame. We can see the market actually went and obeyed what we were expecting. Then we can see at this particular point again, there was an M pattern that was issued on the H1 time frame. First leg, then second leg, and we can as well minimize our stop loss size by looking for a candlestick reversal pattern on the M15 time frame. Another point that I have already marked again was this one, where we had a clear first leg and a clear second leg, and this is how it looked like on the H4. It was actually a shark fin, and we can see that on the H1 it gave us a nameable W pattern. So basically that is how you'll be doing. You'll be actually looking for a shark fin on the H4 time frame, and then get an entry on the M15 time frame. Before we go to the fourth trading strategy, we have a free Telegram channel where you can actually get to learn new things. This free Telegram channel, we actually share free educational content, free signals, free setups, and free trading advice. Make sure to become part of this particular community through the link that I have left in the description box below. Our fourth trading strategy is called the US session reversal entry strategy. This looks to oppose whatever has been issued by the London session. I've actually put some session markers. The one in blue is the Asian, then the one in red is the US session, then the one in colorless is the London session. So basically we are saying when the London session gives a flow that flows above or below the Asian session, like in this case we had a flow that went below the Asian session and it was a sustained run, we expect to see the US to actually oppose that when we open the session. This is due to the fact that a lot of traders will be opening transactions since US session occupies both the London and the Asian session. So we are saying you will be trading against the London whenever you get a candlestick reversal pattern at the US opening. In this particular case, the London was actually going to the downside, and then at US opening, we can see a bullish engulfing pattern that was issued in opposition of what the London was actually doing. In this case, we can see that this is Asian. Then in London, the market went to the upside like that, and within the opening period of the US session, we can see a 3 candlestick arrangement, candlestick reversal pattern. We can see that it was issued at US opening, and the market actually went to the downside. So basically the summary of this strategy is to actually see the market go above or below the Asian session within the London, and then try to oppose that within the opening of the US session. You may actually add market structure to this strategy so that it will be of high quality and it will be of high accuracy. Our last trading strategy is actually purely price action, where we do not need any indicator. Basically, we only look at a naked chart, but the need to determine bias is of paramount importance. So what do we need to do? The first thing is always to determine whether the market is going to the upside or to the downside. If that is going to be a problem on your side, you can actually look at the opening price of a day and then the closing price of that particular day. We can see that on this day we had an upward trend, and then on this particular day we also had an upward trend. The opening and closing of that day, the opening price and closing price of that day were actually way it was the closing was way above the opening price. Therefore, we had an upward trend. The next thing is now to determine a day of consolidation within that flow. What is a day of consolidation? It's actually a day whereby we have the opening price of that particular day and then the closing price at almost equal points. We can see that the opening of this day and the closing was actually at almost the same price point. So if we have that particular case, then the next thing is now to wait for what we call a high-low retest. So a high-low retest is actually the last but not least strategy in our top 5 best strategies. So the first thing is actually to determine whether you are in an upward trend or downward trend, and then determine to see a day of consolidation within the flow of days. After that, mark the low of that particular day, like in this case, and then wait for the market to come back and retest that low on the following day. We can see that at this particular case, this was the low of this day of consolidation, and the following day actually made a retest of that day on the following day. So we are just saying in summary, look for market bias. Is the market going to the upside or is the market going to the downside? And then look for a day of consolidation within the flow of days like that, and then wait for the market to come back and retest the low of the yesterday's day of consolidation or the high, depending on the market context, and then enter. Make sure you always calculate your risk and make sure you enter at confirmed candlestick reversal patterns. And with that, we come to the end of this video, and thank you for watching. I would be happy if I meet you on the free Telegram channel. Have a blessed day.